Hello, everyone. Today on the Final Bar, I'm joined by Julius de Kempenaer, founder of RRG Research. We'll talk about sector rotation, how that relates to the big picture, looking at the S&P 500. And the big picture so far is more bullish than bearish this week, with the S&P pushing further to the upside, up about 0.5% today. But the growth areas of the equity markets really pushing to our higher. We'll also talk about your questions from the Final Bar Mailbag. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets themselves using the power of stock charts, using data visualization techniques to understand key measures of price, breadth, and sentiment. A strategist whose work I followed for years and years named Paul Montgomery. He wrote a newsletter called Universal Economics. For over 50 years, if I remember right. His favorite saying was, the most bullish thing the market can do is go up. And so when you're thinking about whether or not you should be leaning more constructive or less constructive, the market doing what it's doing on a day like today certainly is a vote in the positive column. There are challenges to this market. And again, I don't feel like the market is going up and it is a clear signal of just a resilient uptrend. You have stocks that have bounced off of their 50-day, and I think the remainder of this week is where you really learn whether the uptrend has staying power, whether you should continue to focus on uptrend potential, upside potential for stocks, or whether you should be focused more on downside risk and managing potential capital loss. And I would err on the side of the latter and give up a little bit of the former, the opportunity to make sure I'm prepared. But that's just me. We'll get to all of that and more here in a minute. I'm excited to talk to Julius de Kempenaer a little later today. Coming up on this show, Wednesday, we have Tony Dwyer from Canaccord Genuity in New York. On Thursday, Bruce Frazier, Wyckoff expert and host of Power Charting here on Stock Charts TV. Also, a little earlier today on Stock Charts TV, we ran our latest episode of The Pitch. This is our monthly show where we have 3 different experts providing their stock picks and justifying them and discussing them as a group. We had today Katie Stockton from Fairlead Strategies, Joe Rabel from Rabel Stock Research, and Ms. Schneider from Market Gauge. It was moderated by Grayson Rose from here at Stock Charts. It's going to be on our YouTube channel and on Stock Charts TV on demand later today, and I'd certainly encourage you to check it out. It was a lot of fun hearing their latest ideas. Also, I will be speaking at the Money Show next week. They have a virtual expo focused on ETF investing. I'll be giving a session called 10 Questions ETF Investors Should Ask at Mid-Year. We're going to talk about how to think about the ETF landscape and why mid-year is a logical time to look at the first half of the year, look at your performance and your metrics, and then think about a good game plan for the second half of the year. That's going to be next Thursday, July 11th at 2 p.m. Go to moneyshow.com if you're interested in joining me there for that free event. Continuing on here with our market recap, I did want to start, by the way, with a poll question. We have polls running at all times on our Stock Charts TV live stream page. Also on social media, we'll send a couple polls out a week. This recent poll, before I give you the question and the answers, it's inspired by a mentor of mine, Bill Doan at Fidelity. They had a chart in the Fidelity chart room called the Generals, and it tracked some of the big mega cap stocks that all had the name General in their company name. And so inspired by that chart, which I thought was just fantastic, I asked which of the Generals performs the best over the next 3 months: GE, General Electric, GM, General Motors, General Mills, GIS, or Dollar General, DG. The votes are in. 51% of you said GM, General Motors. Let's look there and see what we all voted on. And it's hard to disagree with this. I mean, this is a stock that made a new high in early June, pulling back to the 50-day moving average, still very close to all-time highs. And I get it's obviously a play on the auto industry, but also the ongoing transition into electric vehicles. Only 19% of you said General Electric. Given the two, I totally get the point. GE is one that's actually floundering at all-time highs. It's not as much in uptrend mode. It's more in consolidation mode. It's been more sideways. I would be blown away if people picked a consumer staples name like General Mills versus much of anything. So I'm not surprised that this got a meager 5% as a contrarian. I'm thinking General Mills might get a vote, but absolutely, this is something that still hasn't gotten above its August 2020 high and really a sideways performer. Look at the relative strength, which is making a new relative low. Dollar General, though, got a nice bid. And it's interesting, the setup here is potentially a nice base that's getting ready to break out. But really needs to eclipse the previous highs there around 220, 225, and that's the level of resistance that clearly has been established. So interesting voting. I like the GM play. Clearly stocks like Ford, GM. It's not just been Tesla. It's been some of the traditional automakers that have had some pretty decent runs there. So I get the argument. I don't disagree. I think that's a fair call. Let's continue on here with our market recap. As I mentioned, the S&P essentially in uptrend mode. Now, this is after Friday's close. A lot of my macro process happens Thursday into Friday to get ready for this show. And then it's over I do a report for my clients on Friday. And then it's pretty much looking at sectors and stocks after that. And Friday, if you look at the macro trends into Friday's close, pretty negative. The S&P is closing down, below its 50-day moving average. You're trading below the 50-day, which puts the current move in line with previous pullbacks. You have some internal weakness. You have breadth measures that are turning much less positive. You have stocks that are testing their 50-day. This week has been a complete mean reversion with a bounce higher and move out of those lows. The question, of course, is, what is a tradable bounce? What is a short-term bounce before resumption of the downtrend? And what's the beginning of the next leg higher? To be honest with you, I still think it's sort of it's an open question right now. I don't think I've seen enough on either side to confirm it. When you break down through the 50-day, we'll look at a chart here, the S&P. When you break down through the 50-day moving average, my comment is always, do you get follow through, right? The next day, do you get a follow through to pushing to new swing lows? We did not get that follow through. The Friday close essentially was the low of the run. And now we've turned higher and bounced right off of the 50-day, like the technical analysis textbook would tell you is most likely to happen in a cyclical bull market. But on the other hand, you have a lot of stocks that are just bouncing off of fairly weak levels. A lot of stocks were oversold, especially in financials and energy, coming out of relatively weak levels. So is it unreasonable that you would get a bounce off of that depressed level? Absolutely not. That's totally reasonable. So I feel like the move we've had this week sort of satisfies everyone. If you're bearish, you can think of it as a dead cat bounce, sort of getting some suckers drawn in before we make new swing lows, and it's all about the downside. If you're bullish, this seems like a garden variety pullback to the 50-day, like we've seen a number of times just year to date in 2021. I think the real question is, how do you break out of this range? Do we break to new closing highs? Do we break to a new swing low? And we'll have to see how the remainder of this week plays out. Today, by the way, the S&P up about 0.5%, closing around 42.46, which is a nice push higher, really threatening once again all-time closing highs. The NASDAQ composite and the NASDAQ 100 pushing higher. The NASDAQ 100 up almost 1%. Mid caps and small caps struggle a little bit relative to the large cap index, especially the mid cap index, which is only up about a rounding error over zero. Looking at some other asset classes very quickly, 10-year yields actually were higher earlier in the day and finished at the lows of the day with a 10-year yield around 147. The TLT, which is the long bond ETF, was up about 0.25%. The dollar index essentially still flat. Not a lot of movement today relative to others. Precious metals down again today. Oil up just a marginal amount. And so overall, you've seen this continued rotation away from precious metals. Last week, I think, was a real change of sorts with the gap down on the GLD related to the Fed meeting. And again, while overall, I still think the commodity story, the long-term super cycle is a decent story that I think would still have legs through the remainder of this year. You're certainly not getting that sense in the short term with a lot of mixed signals and especially more weaker than stronger with gold. Nice bounce yesterday, though. Cryptocurrencies back to mix with Bitcoin and Ethereum recovering off of going to a new swing lows. Bitcoin actually touched 29,000, got to the 20,000 handle last night, sort of overnight in Eastern. You can see it's rallied back up and it's in around the 32 to 33,000 range. The average coin was down today from yesterday at this time. In terms of sector movements, right, this was a move back to the growth side of the equation. Consumer discretionary, technology, communication services, sort of the three clear standouts. Energy was notably the fourth from the top, so actually a nice move higher, sort of narrowly outperforming the S&P, not by much. What underperformed were really the defensive sides of the markets: utilities, real estate, and consumer staples. So while in a lot of days it's actually been value versus growth, right, where one side is really working, the other side is really not, this was more, I would perceive, as more risk on versus risk off. This is more of a vote on the offense versus defense. You can see the offense sort of clearly at the top. You can see the defense clearly at the bottom. And some of the cyclical sectors were sort of in the middle, underperformed a little bit, but not horribly so. This is more of a risk-off scenario. And again, my concern thinking about the big picture is that is what, if I was bearish and wondering what a bounce off of a breakdown might look like, it could be this. Now, again, we make new all-time highs again tomorrow, and further on, I'll have to completely change that and tell you, nope, the uptrend is in good shape. We've bounced off the 50-day as we have many times, and we continue to push new highs. So as I feel like many weeks have felt like a pivotal week, I think the jury is still out on a market that has gone from uptrend mode through April to more sideways consolidation mode. The question is, what could or what would lead us to the upside, or what leads the way downside following a breakdown? We need to take a quick commercial break. We'll be back with my guest, Julius de Kempenaer. We'll talk to you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close as we focus on the message that the markets themselves can provide us through charts. Also want to remind you, we'll do another mailbag segment a little later in today's show. We would love to hear from you and answer one of your questions in our next mailbag segment at the end of the week. You can get your questions to us a couple ways. Number one, via email, thefinalbar@stockcharts.com. Number two, via Twitter @FinalBarSCTV is our Twitter handle. Finally, on our YouTube channel, just put a comment below the video that you're watching. We'll gather all of those questions and we'll hope to answer one of your questions in our next mailbag segment. Also, as a reminder, StockCharts TV is live streaming 24/7 on our website, stockcharts.com/TV. We are also on demand. Go to stockchartstv.com. You can see our on-demand platform. Use your email, set up a free account. You can start watching all of our great content featuring fantastic hosts like Julius de Kempenaer, wonderful guests that come through the Final Bar and our other shows, and all of our great special events. Go to stockchartstv.com to set up a free account. We're also on all the app stores. Just search for StockCharts TV on demand. I want to welcome on my guest joining us once again on the show, Julius de Kempenaer. Julius is the founder of RRG Research. He's the host of Sector Spotlight, which runs on StockCharts TV every Tuesday, 10:30 a.m. Eastern. Julius, always a pleasure to have you on. Thanks for joining us today.
Thank you for having me, Dave, and indeed, always a pleasure. And you know what? When you watch stock charts on demand on TV, you can watch these charts on 70-inch, and that's awesome.
They always resonate in a larger scale, and I have very fond memories, as I hope you do too, of getting together in Boston and elsewhere and blowing up the RRG into all its magnificence in the large scale digital displays. So happy to feature that for
140 inch or something like that. Something crazy size that was.
That was a 13-foot plasma screen. We used to look at that.
Oh my God! Yeah.
We digress. Start us with the weekly RRG, Julius. This has been, I've described this market as rotational, where you just get these big rotations between value and growth between different sectors. We're looking at the weekly RRG on the left side of the screen. Talk us through what you're seeing right now.
Yeah, I'm going to piggyback off your comments because I think I was listening to your introduction and to your description of the market, and I think that perfectly resonates what sector rotation is showing you right now. You evenly said there was something for everybody in this market. If you're bearish, there's something. If you're bullish, there's something. And I think that's exactly what you currently see in sector rotation. There are sectors that are doing really well, like energy and financials, which are far away to the right. They're inside the weakening quadrant, but they've got very high readings on the RS ratio, which means that their relative trends are still strong. We have technology and discretionary inside lagging and pushing further into it. And that is, these are the two biggest sectors. And I think that these are needed if we want to see a further rise in the S&P as a whole. And then we've got a sector like healthcare inside improving, which is traveling towards leading, but also defenses like staples and Utes, they're right left to you right now, and they're rolling over. So there's no clear leadership from the defensives, and there's no clear leadership from the offensives and the growth stuff. So that's a mixed bag, and that is something that makes me cautious, at least a little bit cautious, because this is a situation of sector rotation that often takes place when the market doesn't know and it's uncertain. And I think that's exactly what we're seeing right now. So for me right now, I am focusing on the healthcare sector. So if we can push that in on the right hand side on the template that we just set up, then because healthcare is the sector that was pointed out by the seasonality work that I do at the start of each month in Sector Spotlight as potentially one of the stronger sectors this month. And it is now starting to pick up. So it was a little bit weaker at the start of the month, but it is now starting to pick up. And you can see that turnaround that's building up in that relative strength area. The RRG lines are already starting to point higher. And what I really like is the fact that we're pushing against that 125 resistance, that former peak. So if that breaks, then I think that that rally in price will continue. And that could be the catalyst for relative strength versus the S&P to pull higher and to actually make that push into the leading quadrant. Now, healthcare is a defensive sector. So there's your mixed bag already. Now look at energy and financials. They're very high readings on the RS ratio. We start with energy. Then we had that massive run up through leading. We started to drop off and we're now curling back. Now we know from history that sectors that went through leading into weakening and then start to go back into leading, they're usually starting their second leg of the relative uptrend. So energy, the initial move was there. That's when you go to the chart on the right. You see that the RS ratio line, the red line, was crossing above 100 at the start of the year. That's when XLE pushed into the leading quadrant. Then it started to lose momentum while still maintaining levels above 100 on the RS ratio. Momentum dropped off a little bit. That's when it pushes into the weakening quadrant. And now momentum starts to pick up. And if you then look at the relative strength line above, you can see that there is these two peaks are roughly at the same level. You could even think about it as in terms of a head and shoulders bottom in the making. So if we push above that horizontal level, then definitely the turnaround of that long downtrend that you can see there from, I think it's 2017 onwards, has reversed, and energy will be one of the leading sectors. Something similar can happen to financials. It's not as strong as energy, I believe, but so these are the images, these are the pictures that I'm watching. I'm running out of time, always with you. So let's quickly move to the S&P chart, because all of that sector rotation, all of those mixed signals are leading, for me at least, to have a bias towards caution. Sector rotation signals uncertainty. If I look at the S&P chart, and I'm a simple guy, I use simple charts, and if I use indicators, it's like the RSI or the MACD, and this is a 9-period RSI. I like to use that over 14 because it's a little bit more pronounced, and that negative divergence really stands out there. If you do this for the Dow, if you do this for the Nasdaq, you will see a similar picture. All these major market indexes are not able to confirm their highs in the indicators. That's a warning signal for me. Combine that with the mixed bag in sector rotation. And if you want to go back and read my article in the Chart Watchers newsletter about the signals from the fixed income market, all in all, I got a lot of evidence weighing in that at least we have to be a little bit cautious. And I agree with you. If things change and we break out to the upside, this whole narrative goes in the bin. But I wouldn't dare to risk massively buying at the moment. Let me put it like that. Is that careful enough?
Measured and well taken, Julius. That was a perfect little summary of describing the conditions. And I've described things as rotational. You talking through some of the patterns on the RRG really put a great visualization behind that. Arguably indecision in the markets right now. Julius, listen, we're out of time. Thank you so much for coming on. Thanks for staying up late for us and giving us your point of view. Stay safe, be well. We'll talk to you again soon.
Thanks, Dave.
That's Julius de Kempenaer. Julius is the founder of RRG Research. If you appreciated his perspective, which I certainly did, check out his show called Sector Spotlight. It runs every Tuesday, 10:30 a.m. Eastern on StockCharts TV. All of the previous videos, of course, are on StockCharts TV on demand. But I love that take. I haven't talked about the weekly divergence very much. We bring up the daily chart of the S&P every day on the show. We talk about some of the key signals. When we look at the weekly chart on my show, it's usually using my market trend model, which is more of a trend following model. I hadn't really paid as much attention to the weekly divergence. And wow, when he was describing it, you have the lower peaks in momentum that looks a lot like the first quarter of 2020. That sort of looks like sort of September of 2018. I'm going to spend some more time on that one. I really appreciate Julius highlighting that for us today. Boy, we need to continue on here with our Final Bar mailbag. As a reminder, go to your email, shoot us an email, thefinalbar@stockcharts.com. We'd love to answer one of your questions at the end of the week. First question I hesitate to bring up because it's a meaty one. I'll try to address what I can, but the question was basically when the difference between the oil contracts for December 21 and versus December 22 indicate that the December 22 contract is higher, what does that mean? Or if it's lower, what does that mean? So what you're basically asking is about the futures curve. And to be honest with you, we don't have a ton of futures data on StockCharts. It's really not the game that we're mostly in, but we do have some decent data. If you do the upper little caret, the above the number 600 keyboard, that's what most of our commodities and futures data looks like. And you'll see it on here. So if I bring up the little caret CL, you'll see the contracts, and this is what you're referring to. So just like treasuries have a curve and you have the shortest maturity out to the longest maturity, you can also make a curve using commodity contracts, futures contracts. So if you're looking at the crude oil contract, you can see CLK, CLG, these are the different months. This is based on how these were listed in the Chicago and New York exchanges for decades. This is how we've adapted it here. If you do $WTIC, this is using futures data and making a continuous future, basically rolling all of those commodities together and adjusting them so that the historical data makes sense. So what you were asking is about the shape of the curve. And all I can tell you is if you're thinking about the futures curve and you're looking down there, I would read up and I would search for terms like contango and backwardation and inverted curves. Just like the treasury curve can be inverted, it can be steepening, flattening. You have similar language within a futures curve that actually describes the shape of the prices going forward. And a lot of people that are just getting started in futures don't really understand how that curve works. And it can certainly impact your returns based on how the contracts expire every month or every quarter, how you roll over from one contract to the next on a longer term position. So all I can tell you is absolutely makes a difference. I would look for those terms, contango and backwardation, inverted curves, particular to commodities, and you'll get some information that explains how that impacts the long-term trend in commodities. Next question, what are the best tickers for tracking the housing market? I looked at this a little earlier and just came up with a couple ideas for you. To be honest with you, the main way I track the housing market is usually through the home builders. So looking at Lennar and DR Horton and Pulte Home, they tend to be pretty sensitive to what's happening with housing prices. So that'll be a good reflection overall. If you search for something like home or housing, just type it into the top there. It's a keyword search. And if you look particularly at indexes, you'll find things like this, $HPI is the S&P Case-Shiller National Home Price Index. The challenge with a lot of these housing indexes is they're on a delay. A lot of economic data is usually delayed by like a month or two. And so the problem is you're kind of seeing where things were at a month ago at best. And so it's not really super actionable, which is why the home builders tend to be a little more sensitive to short-term fluctuations. But you can get the longer-term data. If you understand the long-term trend in housing prices, something like that makes a ton of sense if you want to go for deeper history. What I might suggest for you, besides the home builder ETFs, $XBH, $ITB, which are two of the common home builder ETFs, maybe something like the REIT Total Return Index, which is just $REIT. That incorporates other things, not just housing prices, but gives you a sense of the real estate sector and how REITs as a whole are performing. So that's not just housing, that's also things like malls and retail and office space and other stuff are going to be incorporated in that. But between those things, you should get a sense of the data to make sense. I hope that's helpful. And again, for me, I usually look at home builder ETFs and home building stocks because they tend to reflect pretty well on things. Next question, is Dr. Copper smarter than the bond market? I love the phrasing of that question. This is the chart that you sent along with it. Thanks so much for sharing the question and the chart. You're showing a chart of the S&P for the last 2 years. You have the copper index here, which is just $ copper. And then you have the long bond yield, which is $UST30Y. And I think what you're describing here is Dr. Copper smarter than the bond index. And I'm guessing that what you're implying is yields are breaking down. Copper really has not yet, and equity prices are going higher. I guess that's what you're thinking of with your question. Is it smarter? I don't know about that. And I think again, if you oversimplify and suggest that yields have a very particular, the long bond yield has this very particular relationship to stocks, I don't think that's 100% fair, right? There are going to be times when stocks and bond yields actually move together. There are going to be times when they actually move inversely, and it just depends on a lot of other things, right? So most recently, you're seeing bond yields come down while the S&P is making new all-time highs, and 30-year yields, the high point so far year to date was in March. But there are other times, for example, the fourth quarter of this year, where both yields and the S&P were both in an uptrend. So I think it's a little oversimplifying to just kind of group them together. Your comments about copper is fair, and there's a reason why it's called Dr. Copper. A lot of people see it as a great indication of economic growth. And then when economy is good and you're growing, you need a lot of copper for things like wires and stuff. And so it's sort of an infrastructure indicator, right? When things are good, there's a greater demand for copper and it goes higher. When that starts to break down, it's a little more concerning. So, I don't know if I could say lower yields are a great indicator for stocks. I think copper starting to roll over the last couple months is a potential area of a concern. The S&P making new highs while copper does not is probably the thing that jumps out to me on this chart more than anything. And I'm not the only one I think that's picked up on that. Others have seen that similar thing. And it's interesting when you heard Julius talking earlier about the RSI, the bearish momentum divergence on the weekly S&P chart, you're sort of seeing a similar bearish divergence with copper prices, right? You're seeing the S&P making new highs in June, and copper is very much not doing so. Thanks so much for that chart, by the way, and your question. I hope I was able to give some color and context to that. Boy, we need to wrap this show. It goes so quickly. 3 charts in 3 minutes. The 3 and 3. Let's get to it. Chart number 1 is right here. This is the S&P using the cap tiers. We're looking at the cumulative advanced decline lines. I have these color-coded green. I was so tempted on Friday to maybe nudge a couple of these amber, and probably the one that looked the most amber was the mid-cap breadth line, which is back below its 50-day moving average for the first time since back here in September of last year. But it did not make a new swing low yet, right? It's down through the 50-day, not making a new swing low. Given the strength that we've seen today, I wouldn't be surprised if these tick up a little bit today. And I think all 4 of these will be back above their 50-day moving average. But as I'm seeing the S&P show signs of weakening, I'm seeing the rotation that Julius and I were talking about. Breadth indicators like this are a great indication of what the masses of the equity markets are doing. And that's a chart I will be watching going forward. Chart number 2 is Fifth Third Bancorp. While Fifth Third is not the most important chart in the world, I think it's an interesting one because stocks like this, regional banks, have broken down through their 50-day moving average, now testing support around 36. So far this week, it's bounced off of that support level. I think stocks like this breaking levels like that, you will quickly see selling pressure increase as people get more and more skeptical of further upside. Finally, why the S&P is holding up as it is. It's charts like this, the chart of Apple, which is now breaking out of its symmetrical triangle pattern to the upside. It actually broke down through that pattern in May and really started to deteriorate in June, but never really followed through the 200-day moving average. Now it's round trips back to the top of that pattern and is breaking out today. My question, just like we talked about back here, do we get follow through, right? Do we continue after this breakout of the symmetrical triangle pattern? Particularly, do we get above the April highs? Folks, that's our show for today. Thanks so much for Julius de Kempenaer from RRG Research. For StockCharts.com, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.